Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have on Dan Petersen. He is from New York Life. And we are talking about the New York Life FTSE International Equity Currency Neutral ETF, ticker HFXI. We also joked about how much of a mouthful it is to get that all out, but it is a market cap weighted currency hedge ETF, 50% currency hedge. So we talk about how the ETF works, how it operates. We also get into kind of the landscape of international equity exposure and historically how it's been and kind of what we can look at going forward. But without further ado, please welcome Mr. Dan Petersen. Hey, Dan, welcome to the show.
Hey, Brad. Thanks for having me on. I appreciate it.
Sure. So before we get started, why don't you give everybody a little bit about your background and how you ended up over at New York Life?
Definitely. That sounds great. So I've been in the industry since 2003, going on 22 years now. And I'd been in financial advisor roles and junior roles initially, and made my way over to Index IQ as my first ETF position. And from there, 2012 through 2015, we were a small shop, and then were acquired by New York Life in 2015. So for the past 10 years, I've grown from being a hybrid distribution wholesaler into now product management for the past 8 years or so.
So we're here to kind of talk a little bit about the product suite. But before we do that, before we get into, nerd out on the ETF, any hobbies, things you like to do when you're not working?
I do. I'm a continuous learner. So I really dive into anything mechanical. I do a lot around the house, a lot of do-it-yourself stuff. I have 2 kids. They're now 11 and 8. So that takes up a ton of time. But last year, I finally got back into my roots as a kid. I grew up around a boating community, and since then have not had a boat up until last year. We bought a 20-year-old boat, actually, and rehabbed it, and didn't get it in until Labor Day, which was rough. Missed the whole summer pretty much, but looking forward to using it this summer.
No, that's great. I've been I was a do-it-yourselfer for a long time, and then made too many mistakes, and so I'm now outsourcing all things inside the house.
That works. It gets expensive, but it works.
Yeah, and you don't hurt yourself, and you don't come in and you're bleeding, and your wife's like, "Now what'd you do?" So, let's talk about. We're going to talk about HFXI, which is the New York Life FTSE International Equity Currency Neutral ETF. That's a full sentence. So, why don't you start by giving us an overview and what makes this, really a unique product in the international equity space?
Definitely. And that name has evolved over time. We tried to find the most succinct way to say it, and it is still a mouthful for sure. What we're trying to get at with the name is to understand that there is indeed a currency decision that's made when you're investing internationally. The decision, really, there was no decision. If you were to go back 20 years or so, you pretty much just accepted currency risk for what it was. And whether that helped or hurt, you understood that was part of the attribution to the return. And then fully hedged products started to come out to deliver the option that you had the chance now to remove currency risk from the equation and just focus in on the equity exposure. And when those first came out, there was a lot going on in Japan to intentionally devalue the yen, spur exports. They titled it Abenomics back then. And it seemed like a pretty logical trade to want to hedge Japanese yen and go long the equities because of what they were doing to their currency. Unfortunately, if you look at assets in that space, most people were late to that trade. A lot of the assets flowed into hedged Japanese equity products. a little after the fact. And if you were to look at performance of those assets that came in, they underperformed unhedged assets, and it was a bit of a traumatic trade for many. And in our conversations, for those that were around for that, we find that most people just do not want to do anything in terms of making a decision to have or to have not currency, and they just go with the default option. If you look at indices, all indices are US dollar based. So when you're benchmarking, you generally have the impact of currencies reflected in the benchmarks as well. We're trying to deliver an option here that lets people understand that there is a neutral way to do this, to have some currency exposure, but not have as big of an impact as we've seen over the years with full currency exposure. So what we're doing is hedging half of the risk, which allows people to not have as much volatility that comes from currency, but also participate in foreign currency strength when it does happen. And that allows investors to not have to decide, what do I do now? Do I tactically move towards hedging, towards not hedging? Am I chasing my tail? When I look back at performance, I see what has done well, but if currencies mean revert, I might not want to do what has done well. And it gets into a very deep rabbit hole of decision making that is impacted by just a tremendous number of different possibilities, whether it be interest rates, geopolitical risks, and things of that nature. So we're trying to provide almost the most passive approach, which is market cap weighting and half of the currency exposure.
Got it. So for our listeners that might not be, familiar with how to construct a currency hedge, so like at a practical level, how is the fund constructed in order to achieve this, and what types of instruments are used?
Definitely. The short answer is going to be forward contracts, which is kind of the industry standard. It's an agreement where whatever the currency move is over the next 30 days, it's implemented at the beginning of each month with 30-day forward contracts. So the instrument allows you to settle on the difference in the currencies from the beginning of the month to the end of the month. But I might want to pull back just for a second and review what's happening here, right? Again, most people understand that when you invest internationally, there's a currency impact, but why and how does that work? If I take my money and I put it into a Japanese equity, I have to convert my US dollars that I'm investing into yen. It's now on their market, and I'm buying Toyota or whatever Japanese equity I want to buy. Toyota or whatever equity it is goes up 5%. Cool, I get my 5% return. But in the meantime, the yen also devalues versus the dollar 5%. So when I translate that back to US dollars, I actually have a 0% return. It is, 1-for-1 going to reduce or increase my return. So it is significant. And if you look at this on an index level and you assume, okay, there's, Japanese companies in here, there's European companies in here, all the different developed nations and the various currencies that are involved. And if I look at that as a holistic approach from an index level, it is not uncommon to have 1,000 basis points or 10% of attribution in 1 year, up or down. That's kind of the widest part. Currencies move throughout the year, so we see on average is about 600 basis points of additive returns or detracting returns. But again, it can blow out to as much as 1,000 basis points in either direction. So great if it helps me, but if I'm subtracting 10% from my return on equities, I don't know. If I'm planning for that, am I having a strong opinion about that? And if I don't, I might want to reduce the exposure there because that's pretty significant.
So can you talk about kind of maybe different market environments and how this would perform in those environments and in those conditions? Like, what is ideal for this product? What type of situation would be ideal? What type of situation, might be a little bit more difficult? So yeah, if you could just share that, and I think it'd be super helpful.
Absolutely. The great part about this product is it's designed to be that all-weather long-term allocation. So there is a good condition if I were to look at this compared to a fully hedged product, and there is a good condition if I were to look to this compared to an unhedged product, which when you look at the category, and I look at the assets in the foreign large blend category, 99% of assets are in unhedged products, especially if you're looking at market cap weighting. So there aren't a lot of assets in fully hedged. So you kind of wonder if it's worth comparing it, but I will anyway. But the bottom line is there are periods where currencies will help you and currencies will hurt you. Generally speaking, it's when you have even and expected inflation and stable growth that foreign currencies will strengthen relative to the dollar. The US dollar benefits from risk, right? There's a flight to quality trade that happens where everybody starts to go into the dollar for stability if we're in a market downturn or any type of recession. But there's also high growth scenarios like we've seen over the past several years where there's a US dollar strength phenomenon that happens as well, just because there's a lot of US centric growth happening globally. So if you think about that, there's this phenomenon called the dollar smile, right? So there's these two ends of the spectrum where the dollar strengthens, and then there's that middle ground, which actually should happen more commonly, where you have expected inflation and stable growth, where foreign currencies can benefit. Unfortunately, especially for that left tail, where we're in a recessionary environment or risk-on environment, equities are moving down, and there's a flight to quality with the US dollar. So if you have both equity and foreign currency exposure, you're kind of getting double the downside. And we saw that in 2022 when the international indices performed as poorly as U.S. indices, right? The S&P 500 was down around 16%. I don't remember the exact number. And if you were to look internationally at, an MSCI EFI index or a FTSE developed markets index, it was also down about 15, 16%. And if you look at the attribution of that, the equities were only down about 8%. So it would have been an okay diversifier to have, part of my equities only down 8%. But because of the currency impact, it was down as much as U.S. markets. So especially in those risky environments where both equities and currencies are down, that's where any amount of hedging is going to be appreciated in the portfolio. If you're great at timing these things, go fully hedge, time it, cool. And then get back into unhedged, when it's working for you. But these cycles play out short, medium, and long term. So it's really difficult to play around with a portfolio and time it right. And our approach is have some to benefit, but also lower the risk so that it's more in line with what people might generally expect. If currencies by and large long term are contributing, 30% of the return, I'd want to have a pretty strong opinion with something that powerful. 15% of the return, here's something where I can kind of say, okay, it'll help sometimes, it'll hurt sometimes, and I'm kind of okay with that level. And that's why the 50% number works pretty well.
So the non-hedge portion of this portfolio, you've got like 800 equities in there. Is it just strictly a mirror of the FTSE index? Is that the exposure at market cap? You're not doing any other ancillary stock selection or active nature in there. You're not, you're not taking an opinion. You're just merely following the index.
Correct. Yep. It's replicating the index. So what the index shows is what this will have in terms of, active selection. It's purely passive. So you're not seeing that. And, it's worth reiterating, especially, with this kind of conversation that, the returns come from the equity returns plus or minus the currency returns. So those that are unhedged are having that equity basket exposure, and then the currencies can contribute or detract on top of that if you're unhedged. And there are slight differences between FTSE and MSCI and all the various different index providers. Some will consider, FTSE considers South Korea and Poland as developed, whereas MSCI does not. So you have a little bit of different country exposure. Vanguard has a product that tracks also FTSE, but it includes Canada. So MSCI EFI does not include Canada, but FTSE, the version of FTSE that Vanguard uses with one of their products does include Canada. So there's all different ways to slice and dice developed markets exposure. And then you can go out into the all world, category where you're now including emerging markets as well. So, you can look at these very different ways, even though they're market cap weighted. But generally speaking, if you were to look at correlation, very high with straight developed markets exposures. You're looking at 99 plus in terms of correlation over most time periods.
Well, why don't we talk about, the international sector as a whole and take some time there, because, I've looked at the charts. I'm sure you're aware, international is just I don't know if it's 3 standard deviations now away from, kind of the mean with US equities. But, I'm of the camp, and I think you've said it earlier, that sometimes things mean revert. Are you guys getting a little bit more excited about international exposure over there, or what are your thoughts?
So I wrote a primer paper about this a few years ago. I feel like you might have dug this up or something with the standard deviations. Um, so I think you're referencing price earnings ratios, right? And basically the fact that international indices generally exhibit a discount in valuation to domestic equities. And this is what any international equity provider or strategy is going to talk about in terms of why international is attractive, because you have lower valuations and more room to grow versus the U.S. It gets tiring though, because that's existed forever, right? So it's just like, I've heard the story 100 times. Of course they're discounted. The U.S. is always priced a little higher. There's more demand for U.S. companies, it seems, in the open market. But to your point, there is a range. It's always discounted, but it's been, in the past we've seen, US PE. If we look at the S&P 500, might have been in the low 20s, and international might have been, 15, 16. So it's discounted, right? We're looking at maybe like 75% or so in terms of the price earnings comparison there. But right now, if you were to look at developed market indices, whether it be FTSE or MSCI, you're looking more about 17, maybe high 16s, and the U.S. is 27. So now it's really stretched, to your point, several standard deviations away from the average. And I'd argue maybe even in the bottom 10th percentile. That's about how far away we are within that range of discount. So the rubber band is definitely very stretched right now. And that paints a picture of opportunity, whether that be the U.S. comes down or the international catches back up. We don't know where we'll go. But when I look at a portfolio and you say, what's the opportunity for international, it's definitely a diversification potential. And there's evidence using price earnings to be able to point to say, why we're making this decision, maybe to start to increase international exposure in a portfolio again. And we are starting to actually see that pick up. That was a long conversation for many years in the working. But if you look at Morningstar flow data in the various categories, we do see foreign large blend picking up a little bit in assets compared to what it's done historically. So there's definitely opportunity there, and we also see things like central banks are already starting to cut rates. They were a little ahead of the U.S. in terms of the rate cutting cycle, which might point to opportunity as well overseas, compared to the U.S., which is still a little restrictive. And we don't know how fast the U.S. will be going forward in terms of cutting rates.
Yeah, well, I don't know if they're going to be cutting rates at all. We'll see this year, but it's interesting to me because if you're seeing flows again, that's great. But there was periods of time there where I was having conversations with advisors, and they're like, "Why am I still including international exposure inside of my portfolio? It's just been a drag." And they understand the diversification benefit of it, but from a portfolio construction standpoint, they were just getting fed up with it because, as you know, and I know, and a lot of people that listen to the show know, is you've got basically seven to 10 companies that have propped up the S&P for the last, 36 months. And if you're not invested in market cap weighted US indexes, specifically, the S&P 500 and the NASDAQ, you can't keep up. And so I understand their argument, but to me, and to your point, you don't know which is which, right? You don't know whether or not the US is going to come back to earth a little bit, or if you're going to get this catch up from international equities. I tend to favor the first part of that, the US probably could use a little bit of a cool off here and allow that kind of differential catch back up a little bit. But I think just as an asset allocator, you got to continue to look at internationals and even some emerging markets as a place to diversify some assets. But I don't know what your take is, but to me, it just seems as if asset allocation or, traditional asset allocation has been really tough for advisors over the last handful of years. And you're starting to see some massive concentrations in portfolios, not only to specific stocks, but, I'm seeing portfolios where people have 30% exposure to the MAGS ETF. They just want to buy the 7, and it's it's frustrating as somebody who helps assist in that process to see it because it's coming.
Yep. And those numbers, they're so stretched. I mean, you see them in articles every once in a while. I actually pulled them recently. The percent in the top 10 names for the S&P 500 is 36% right now. And if I were to look at international index concentration, it's closer to 12. One's almost at 13 right now. So yeah, the concentration benefits internationally also is a big help. And I'd also mention that I'm putting together some research right now actually to look at historical periods. Right, history can't be counted on to repeat, but we've seen some historical examples where we had a strong run in U.S. equities, and the last time we had as strong of a run as we have currently, right, which is excess of 20% annual returns in 6 of the past 8 years, which is pretty wild, right? It's a lot of people have only been around for 8 to 10 years, only know this. But if we look back historically, we have the tech bubble, right, where you had it was similar, where you had a handful of 20+% years in the S&P 500, and then the prior period to that would be the late 70s, early 80s, where we had a strong run in U.S. domestic markets. In both of those prior periods, and it's not a large number of periods, it's only 2 periods that we can look at. Both of those prior periods, the international indices exhibited annual returns in excess of 20% for the following several years. So it was a place to go that maybe had a little bit of a like a tag on performance from U.S. strength. One period, of course, the tech crash didn't end well for U.S., but the late 70s and early 80s, actually, the U.S. continued to have decent strength. It wasn't 20+% year returns. You were better off diversifying internationally, but it's good to see that historically, this all doesn't end poorly, right? There is some kind of light at the end of the tunnel. It doesn't have to be that everything goes down and international goes down less. It could actually be that international does have strength going forward, and maybe that's a bolt-on effect from what's happened in the U.S.
No, that's great. So when we're just talking about this product specifically, HFXI, when you're sitting down with an advisor or talking to someone about how to use it, where are you? I mean, obviously it's going to be in that international sleeve. Are you pairing it with just traditional market cap weighted only international, or do you think that this is just a better alternative to that because you're getting some currency hedge? Like, how would you try to really position this and using it in a kind of overall model diversified portfolio?
Yeah, it really depends on what people are looking for, right? Some people love active for what it is, and this isn't something that would compete necessarily directly with active. It could be a core satellite type of approach where you have core market cap weighting, and there are reasons to pair this with active, and more so than anything else, it will be volatility reduction, actually, because the currency in and of itself provides a separate and distinct series of returns that exhibits its own volatility. So every bit of currency that I take out in terms of exposure lowers my volatility of the overall strategy, and that's going to hold true at the index level. You can find individual countries where currencies could be negatively correlated to equities, and that kind of exists in short periods where reducing currency risk could actually increase your standard deviation. But it's actually very rare to find that in the developed world, and especially at the index levels. At the index level, there is a slightly positive correlation, but it is a separate and distinct time series return, because there are times where currencies correlate and times where currencies don't correlate. But by and large, when I reduce currency exposure in the portfolio, it takes away volatility. So we look at this as a way to pair with active in order to lower your volatility and maybe come closer to a benchmark exposure, but maintain your active exposure as well, as a satellite or to whatever extent you want to maintain active, and definitely as a passive substitute in portfolios for international. Just again, maintaining your market cap weighted equity, not tinkering with your equity weighting. There are smart beta strategies and other ways to approach international to try to reduce volatility, but many times we find that sacrifice returns as well. So this is a way that you don't give up any equity exposure whatsoever, but you're able to reduce your volatility through currency reduction.
Got it. Well, Dan, I really appreciate your time with me, and congratulations on the success with this product. I mean, it's had a consistently 5-star, Morningstar rating. Good flows of performance over the last year. Over the last 5 years, given how weak international has been, the products perform very, very well. So, but before I let you go, where can people learn more about this product and New York Life as a whole?
Yeah, so nylinvestments.com is the homepage. And just same website, nylinvestments.com/HFXI will get you to the page for the fund.
Well, again, Dan, thanks so much for being here.
Thanks, Brad. Appreciate being on.